These are the groups that are also accumulating copious amounts, like JP Morgan, over 1 billion ounces of silver and 45 million ounces of gold, according to Butler. If that really is the case and the banks are not shorting, what that tells you is that ultimately, as the price continues to rise, the main entities that have been stopping the rallies for the last 4 decades are sitting on the sidelines.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for December 13th through December 20th, 2022, while supplies last. This week we feature 2 sovereign coins, the 2022 Silver Krugerrand and the 2023 Silver Britannia with Queen Elizabeth, both at $4.75 over spot, the lowest premium we've seen on sovereign coins in almost 2 months. Made by the Rand Refinery and the South African Mint, the Krugerrand is one of the most recognized coins today. These Silver Krugerrands are 3/9 fine and feature a springbok antelope on one side and the portrait of Paul Kruger on the other. The 2023 Britannia from the Royal Mint in London still feature the portrait of Queen Elizabeth II, even though the Royal Mint has already started minting some coins with King Charles. This makes this first run of 2023 Britannia likely to be the last Queen Elizabeth Britannia issued. Both the Silver Krugerrand and the Silver Britannia come $25 to a tube and $500 to a box, and both are IRA eligible. And if you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this returning guest. Andy Schectman is the CEO of Miles Franklin Precious Metals. He joins us every week for this Tuesday weekly market wrap-up. Andy, thanks for coming back on Liberty and Finance this Tuesday, December 13, 2022.
It's crazy. It is absolutely crazy that we're here at the end of the year done again. I mean, the blink of an eye, but it's good to be here and always look forward to our Tuesday get-together. So, as always, thanks for having me again.
Yeah, absolutely. One of the things that we look to you for is an inside view behind the curtain of what's going on inside the greater supply chain of the precious metals bullion industry. Before we get to that, if we could look first at the big picture, you've brought to our attention over the past couple of years this whole thing about the global pivot away from the U.S. dollar and the BRICS nations in particular. Can you talk to us about latest developments in that before we get into the bullion supply chain?
Yeah, one of the things that I always have found most interesting about this, as I've titled it with you way back when, was a linear progression of events. And the progression of events that we've seen, that I started talking about in 2017 or 18, was very slow, was very methodical, was plotted, and was pattern forming, if you were paying close enough attention. There was nothing shotgun style about it. There was nothing that was fast and furious, if you will. And one of the things that interests me, I guess, is the greater expediency in which all of this is formulating, the greater speed in which we're seeing momentum gather. And although not a lot has happened since we last talked, there are a few things certainly worth talking about. A few weeks ago, we surmised and we assumed that we would see Xi Jinping go and visit Saudi Arabia. Well, he indeed did, wrapped up a 4-day trip with Saudi Arabia, which is a very big deal. I mean, to me, what this signals is more concrete proof that the days of the U.S. dominance as a petrodollar, as a world reserve currency, are arguably coming to an end. And when you see these types of deals that have been structured between the Saudi kingdom and China, and the promise to expand trade agreements, not just trade agreements, but also things such as aerospace and in terms of a greater economic expansion, not just oil, and cooperation, to me, signal that indeed we will see Saudi Arabia join the BRICS. They also came away and said that they would agree to hold a summit every 2 years. And the article that I read that talked about it, at the end, it said, "Rest in peace, petrodollar." What you are seeing, we often joke about the Chinese think in terms of decades and centuries, and the people in the West think in terms of hours and days. You can see the pieces are massively being put into place. We don't have to look too much further down the BRICS channel to see Russia and India just announcing that next week they will start testing a new payment mechanism using rupee in settlements between India and Russia, circumventing the dollar. And, this is a big deal. All of the demand for dollars settled around transactions in energy and most of the world's commodities settling in dollars. You are seeing a concerted effort by these BRICS nations, whether it be in unilateral trade agreements or on a much more broad scale, finding ways to quietly promote exports in their own currencies and to wane themselves from the dependence on the dollar. And all of these trade agreements, in the eyes of the countries doing them, are expected to help boost mutual trade amongst those two countries, and again, move away from the dependence on the U.S. dollar. I guess one other thing that I'd like to talk about, just regarding BRICS, as there's not a ton to talk about today, is the amount of silver that has been imported by India. By the end of November, the import numbers for 2022 were passing through 8,000 tons, which is about an 80% increase from the year before, which was about 4,500 tons for the whole year. And there's still a few weeks left to go here. So when we wonder who is buying up all of the gold and silver that are leaving the foreign vaults, whether it be the London Metals Exchange or even the Shanghai Gold Exchange, or of course the COMEX, it's very obvious. We noticed China came out last week and affirmed that they are indeed one of the whale buyers, that no one knew who had purchased gold in the third quarter, that indeed they have, for the first time in several years, expanded their or increased the number of ounces that they say that they hold. Of course, we all believe that those numbers are very misleading and woefully underreporting. As Alistair McLeod talks about, 38,000 metric tons he believes they hold. Their report was somewhere in the neighborhood of 35,000 metric tons under that number. So here again, you have to think, why would any country want to really be forthright about the amount of gold that they're holding? And if Alistair is right, they own roughly 5 times the amount of gold that the United States does. But they publicly came out and said that they were part of the entities or part of the groups that have been accumulating metal. And so all this metal that's leaving the West on a one-way ticket eastward is never coming back. And we surmised that China was part of it, and so is Saudi Arabia, and so is India, so is Russia, all of the countries that are adding to their stockpile to reinforce their position in this new system. That's where all the gold is leaving from, or leaving from the Western vaults. So I found it interesting that most of the conversation is dominated by gold purchases, yet you're seeing a country like India who is really ramping up their intentions of accumulating silver. So interesting to note. As far as what else has been going on in the BRICS, just more of the same. Countries making new relationships with one another. Nothing earth-shattering here other than what we've talked about here. Nothing earth-shattering to report, but I'll be watching and listening. And, if I had to guess, and this is just a guess, 2022 was the year of the Ukraine, and I think 2023 is going to be the year of the BRICS. I guess we'll see, but it's not too far away to start making judgments in that respect. And that to me is where I think we will see the majority of the newsworthy items heading into the new year.
There's two aspects of what you just talked about I wanted to touch on. One was in this last part where you said it's unusual to think of a country being forthcoming about how much they really have, but you see their actions speaking louder than words as far as how much they're buying. But you find out in arrears. But it reminds me of the quote, I think it was from The Art of War, where it says to appear weak where you are strong or appear strong where you are weak. And you don't want your adversary to know what you've really got. And this sounds like one of those cases where the East have been accumulating physical, gold and precious metals hand over fist now for years, and yet under-reporting it, according to people like Alistair MacLeod. The other one was when you talked about countries such as India forging trade agreements with China or with Russia. I guess that whole BRICS conglomerate forging trade agreements with each other in settlement currencies that are not the US dollar, that eventually we keep getting warned by people that means some of the necessity by which they've had to hold and purchase dollars to do foreign trade settlement will be not necessary in the future, and that there will be a potential date when they will start releasing those dollars. Some people say that's already started, but it's nothing compared to what we're going to see. And it reminded me of the question that a lot of preparedness-minded people have, including our subscribers, who sit there and go, well, if the dollar's going down the drain, you can see it happening, you can see it coming, you can see it continuing, you can see the trend, and yet you still got to hold dollars. And Rick Rule, among others, says you need to maintain dollar liquidity. So that's been a burning question in the minds of a lot of preparedness-minded people is, well, how much cash should I be holding and how much balance should I leave in the bank right now, given that whole system is going down, but it's the only system we've got right now, so you still got to be in it until you're not. So wondering how much of a holdover effect there's going to be and after these new trade agreements start functioning until finally these countries feel comfortable taking the risk of releasing their dollars. Like, okay, we're not going to need these anymore. We've proven we can get by without them.
Yeah, well, that's the $6 million question. It's not just for other countries; it's for people here in the United States. And when you look at people here in the States wondering about that, it makes it even more difficult to figure that question out when you talk about bail-in legislation and money market gating and the systemic nature. You look at a FTX debacle, which hasn't even worked itself out yet. But you wonder how many companies are going to go belly up that we haven't even really factored into the equation yet. And if that happens, or just by the very nature of this economy, when banks start to pull one another down due to the systemic nature of it all, how interconnected is the whole system? Why did they impose bail-in legislations? Why did they impose money market gating legislations if it not to be something to think about? So, yeah, I think it's very difficult. On one hand, I understand avoiding the big loss. I understand the concept of diversity, and that's what the whole concept is, avoiding the big loss, not being too centered into one area where you can end up ruining yourself if you guess wrong. I get that. I really do. But I think where we are heading right now, diversity is equally has as many perils as being, instead of being broadly diversified within the primary trend. In other words, to me, the idea is to identify the primary trend, period, and which way the river flows, broadly diversify within it. But a portfolio that is broadly diversified amongst several asset classes, I think, will do very poorly in the respect that in a rising interest rate environment, stocks, bonds, and real estate are going to be affected substantially. And when you talk about what is a diversified portfolio within the U.S. ecosystem, it would be stocks, bonds, and real estate. I always focus back on my mentor, Richard Russell, who talked about being broadly diversified within the primary trend. In other words, if you would have realized that real estate was the place to be 30 years ago, and you have a few $1 million and you broadly diversify within the primary trend, you buy some real estate investment trusts, you buy some residential homes, you buy a strip mall, You buy a condo, a couple of condominiums, you buy an apartment building, you buy some raw land. You are well diversified within the primary trend. If you talk about what I believe is the primary trend right now, it ultimately is of a waning dollar. Now, there will be some dollar strength along the way. We've seen that. Brent Johnson's milkshake theory is playing out right now, where the dollar is the best option out of a bunch of poor options. And that will change when you see, I think, when you see the BRICS nations issue their reserve currency. That will change when I think gold is perhaps revalued by the central banks and is levied much higher, and the demand for things other than U.S. dollars will take shape. But if we were to look at that right now within the primary trend, I would say if you think the dollar is ultimately on the way down, then you broadly diversify within that primary trend. And yes, that would involve precious metals, gold, silver, platinum, might involve mining shares, might involve agricultural land or agricultural ETFs, might involve oil and gas plays. All of these things are opposite the dollar, and you are diversifying within a primary trend of a falling dollar. To me, that is the best you can do. But I think real diversity is invented out of fiduciary responsibility by financial advisories. And this is not the time to be broadly diversified. This is the time to identify the primary trend and then diversify within the primary trend. So, yeah, it's a tough one. It's a tough one with the dollar. But I do believe that ultimately the dollar is going to be hurt. And so for me and my money, it is diversity within the primary trend of a falling dollar rather than broad diversity, which will just simply make you the best of the worst or the worst of the best. And it's the easy way out, if you will, one that doesn't take into account accepting any responsibility. And I've always been a big advocate of that. We accept responsibility in everything we do. Yet when it comes to arguably the most important thing right now, and that is the direction of your assets, when most of the people listening to this podcast know more about what's happening in the world than their financial advisor does. Now, let that sink in for a minute. And we are in uncharted waters. Most of the people who are giving advice, not most, I don't want to cast a wide net here, but let's just simply say many of the people giving advice to you all about where to deploy your funds know more and more about less and less until they've known everything about nothing. And what you listen to on Dunnigan's podcast or others that I'm on throughout the ecosystem here puts you in a position arguably of knowing more than the people you're paying to manage your money. And I say that with 100% sincerity. You can be smart as hell and very well read, like some members of my family who are really smart and really well read. But when I go to Thanksgiving dinner, my mom says, don't you dare say a word about A, B, C, D, and E. No politics, no economics, it's just family. The point is, even the people who I love and cherish, who are very well read and very bright, they're just reading the wrong damn stuff. And the same thing could be true and said about financial advisory. So, in a nutshell, what do you do with your dollar? You trust your gut. And if you're following anything I'm saying, you diversify broadly within the primary trend opposite the U.S. dollar. To me, that is the path that I am choosing, and I'm taking accountability for it. I'm telling you all, this is the path I'm choosing. If I'm wrong, it's on me. If I'm right, it's much easier to easy isn't the right word. It's gratifying. Similar to the stuff that I've been talking about for 3 years on your show, Dunnigan, that no one was talking about it back then. Put myself out on a limb, talked about it to the point where I had to wonder, am I talking about this too much? And now everyone talks about it. So it was gratifying. And if I were wrong, it would have been on me, and I would have been a fool in front of everyone out there. So the point of it is that you've got to take accountability, and now is the time to do it, even at the expense of, embarrassing yourself in front of people who you love, because I think this is a once-in-a-generation opportunity not just to survive, but even if chosen wisely, to thrive.
When you talked about different asset classes and how it's really not even true anymore that you're broadly diversified if you're in stocks and bonds and real estate because they're all correlated to interest rates, we have a free guide. If you just email us at libertyandfinance@protonmail.com, that's libertyandfinance, all spelled out, at protonmail.com, and just put the word guide in the title and your name in the email, we'll send you a link to a guide that includes a link to a study that was done called the Ibbotson study, commissioned by the BMG group, that shows in data and in detail and in charts, is very engaging. It shows how the risk correlation of different elements of stocks, bonds, and real estate and different asset classes are no longer effectively hedges for each other as they may have been in the past. And that if you really want to be hedged, you've got to be in precious metals as well. So write the word guide in your email to libertyandfinance@protonmail.com. We'll send you that free link.
Yeah, that's a big one. I like that Ibbotson report. And what it also says is that stocks and bonds are no longer inversely correlated. They are positively correlated. And that's what you're getting at about a hedge, where a portfolio of bonds would hedge your portfolio of stocks and vice versa. Well, not anymore. Now they're both positively correlated or inversely correlated to a rise in rates. And so that loss of the inverse correlation means that you don't have a hedge unless you have something like precious metals. And it was the finding of this report and of this study that the only inversely correlated asset class any longer to the U.S. stock market are precious metals. So from a standpoint of diversity, even within more of a mainstream portfolio, in this case, a 60-40 stock bond portfolio, having some precious metals has never been more important.
Also wanted to add a tidbit, as you mentioned, that many traditional financial advisors that are out there today are just telling people the same old, diversified portfolio of stocks, bonds, and real estate, and that's not effectively going to help them. We have had a continued occurrence of individual financial advisors calling us up and saying, not only am I concerned for my own financial situation, but I'm concerned that I can't keep just telling my clients, they're saying to us, the same old anymore, because we're really concerned about how are we going to protect our clients. So many of them are starting to refer their clients for precious metals. Even in some cases, it goes against, some of their policies, that sort of thing, that say that they can't let money get out of management, but they realize here that if they really do care about their clients, they've got to help people take care of themselves. And even Gregor Manarino, who we interview regularly on our channel, says you've got to bet against the debt, and that means having assets that as Bill Holter, who we just interviewed last night and posted, said cannot be bankrupt. Gold and silver are assets that cannot bankrupt. So now we've seen since Thanksgiving a shift in the direction of the retail bullion market, and we've seen a shift in the direction of premiums. Can you talk to us about what's going on there, what you're seeing, and whether this was expected or unexpected?
Totally unexpected. The premiums have come down considerably to the point where I have never seen them fall the way that they have in a very short period of time. Now, what that really means is that business in this industry slowed down considerably around Thanksgiving. Now, I don't know. Part of me feels that, well, what's really changed? Nothing. In fact, arguably, things are getting worse. Yeah, the nonsense CPI numbers, again, here today, are better than we had anticipated. But look, the draining of the strategic petroleum reserves to 40-year lows add to the energy prices seeming better than they are, the inflation in energy getting better than it is. And what do you expect when the mortgage rates go to 7.75% on a 30-year? You're going to see a slowdown in real estate. You're going to see some slowdowns in these numbers. So, that's to be expected. But the slowdown in the industry was a little bit surprising, and maybe it has to do with, for the first time in 2.5 years, people have been able to freely travel to go see their family. and they just wanted to let go. I mean, I get that. I've been working so hard, and you've been working so hard that Thanksgiving was just a wonderful respite. And, Thanksgiving is ended, and we're just a few weeks away from Christmas and New Year's. Maybe that has something to do with it. But that slowdown in the industry has dropped premiums considerably. Not remarkably, but considerably, at a speed that I'm not used to seeing. So from a standpoint of getting physical product premium-wise, it might be the best it's been literally since 2020. But this is short-lived. Again, I really do believe all it takes is for one more rally or one more event or one more realization that this is what we need, and you'll see things dry up again. One other thing is that typically this would be the time of the year where we would see this happen, because what you have is commitments being made by distributors and dealers to purchase next year allocations, which are now all coming out. So when a dealer says to a sovereign mint or a primary distributor, yes, I'll take $50 million worth of this stuff, well, you're going to drop the prices on other things, or you're going to sell stuff much less during the Black Friday or the Cyber Monday or whatever it is. The premiums have come down because of commitments being made for new allocations at the beginning of the year. Look, nothing's changed in my opinion. What has changed is the price of coins and bars have gotten more affordable, and that's good. So, take advantage of it, because I'll tell you this, getting product does not seem any easier to me at all. It's just a little bit confusing during the first month of a new calendar year or the last month of this year heading into. So because we've already purchased 2023 allocations, we're already receiving 2023 allocations. And so when that dries up, which it will, probably before the end of the first month, before mid-January, you're already running through your early allocations and you're trying to get more. When I look at the price sheets of the big distributors, there's more out there than I've seen in months, but every single one is got in parentheses, limited. So yes, we're seeing an influx of 2023, an influx of new product coupled with a slowdown in demand over the holidays. It's a sweet spot. It's totally a sweet spot if you want to buy metals, unless you think that by Valentine's Day or by tax day, the world will be a much better place and all that ills this economy will be behind us, then don't. But if you don't think that, and you think we're in just as precarious a position as we were a month ago, then this is just a gift. It's a subsidy, one that is driven by the new allocations and by the holidays, which in total represent as good of a buying opportunity as we've seen in quite some time based upon premium. Look, and over the last several months, we've seen gold move up $200. We've seen silver move up a few dollars. So technically, we could expect a little bit of a retracement, a little bit of a pullback. And I think when you look at availability, premiums, and the potential technically to see the moving averages get a little closer together and a little bit of a pullback would not be out of line. So it's a good time to be, if you've been waiting or thinking to make a purchase, it's a good time.
What weekly special do you have? I would expect this in background that you've described there may be lower premiums available.
There are, and we have at the same price, and I hope you'll correct me if I'm wrong. My brain gets a little mumbo-jumbo during the day. I believe they're both at $4.75 over the price of silver, and they will be the 2022 South African Krugerrand, and those come in tubes of 25 and sealed mint boxes of 500, and the 2023 United Kingdom Britannia, same thing, tubes of 25, boxes of 500, while supplies last, $4.75. I can't tell you the last time I've sold coins like this at that low of a premium. It's been many, many months, so it is a good value if you're looking to get some sovereign-issued coins. The Krugerrand, to me, is really the interesting one because It's a harder coin to get. Most companies sell them at higher premiums, and it's also doesn't have any of the it doesn't have the effigy of Queen Elizabeth on it, and a lot of people prefer that for whatever reason. The non-denominational coin, and denominational is really the wrong word here. No affiliation with the Queen, I guess, is really when you realize that 3 of the 6 major mints have Queen Elizabeth on them. Actually, it's at 4. It's the UK, it's Australia, it's Canada, and that would be it. So the Eagle, the Philharmonic, and the Krugerrand are the 3 that do not have Queen Elizabeth on them. A lot of people like them. They typically sell for a higher premium. So to me, that's the one that I like. The UK Britannia 2023 is a fantastic coin too, and both are in stock for immediate delivery. One last thing, then again, I wanted to mention I want to read one paragraph that I got from my friend Ted Butler in his most recent letter. And Ted has always talked about what the commercial banks do in a rising market. They short the rising market. And that's never considered wise, right? You only short a falling market. But when the market is rising and you short it, you are really putting yourself out there to unlimited losses unless you have a big enough bankroll where you can just overwhelm the bullish long players. Well, he in his last article, he talked about, well, let me just read this. And I think this should give people something to think about over the next week. So for the first time ever, there was a stark and stunning difference between the commercial sold short over the past month, what the commercial sold short over the past month in COMEX gold and silver, according to the running COT reports. And he says that he can't imagine this being a reporting error of any type because it would suggest a massive level of incompetence. But basically what he is saying is this. He says something has basically changed drastically enough that the banks would have always shorted heavily, particularly on a concentrated basis, on any and every gold and silver rally over the past 4 decades. So what he's saying is that the commercial banks suck in the speculators who go long, and as the price rises, they short the heck out of it, and then everything expires worthless, and they rinse, wash, and repeat. But he says this is not happening. In fact, he says the commercial banks that have shorted heavily, particularly on a concentrated basis on each and every gold and silver rally over the past 4 decades, are no longer shorting this rally as they always have. For the first time ever, the banks, both U.S. and non-U.S., which have collectively dominated and controlled prices on COMEX for 40 years, have taken a back seat to some other commercial traders. This does raise the questions like who are the other commercials replacing the banks, and why aren't the banks adding more aggressively to the short positions? So I just want people to think of it this way. The commercial banks are the most informed and well-funded traders on the planet. They are not shorting this rally, someone else is. And so when you look at it from that perspective, they never lose. They might lose a battle, they never lose the war. And one of the things that I've always said is that these are the groups that are also accumulating copious amounts, like JP Morgan, over 1 billion ounces of silver and 45 million ounces of gold, according to Butler. If that really is the case and the banks are not shorting, what that tells you is that ultimately, as the price continues to rise, the main entities that have been stopping the rallies for the last 4 decades are sitting on the sidelines. Now, it's early, but it is something to think about. It is something to be optimistic about. So maybe next Tuesday we'll have some really interesting things to talk about on the next COT report, see where the commercial banks are, and see if maybe they're actually adding to their long positions and are going to let this rally run. One of these days, the rally will continue to run, and everyone who's been expecting a pullback or a better place to entry based upon the fact that it always turns over, maybe, just maybe, it won't. So in any case, I just wanted to throw that in there. I wish you and yours a great weekend. And again, everyone out there, stay well, and I should say a good rest of the week before the weekend. And I look forward to picking up with you where we left off next week.
Well, thank you very much for that, Andy. And we're grateful for your presence always here with us for these weekly market updates. And folks, don't miss any of these. Make sure that you subscribe at libertyandfinance.com. You can just put in your name, your email address, and click submit. And then make sure you respond to the email that comes in for your confirmation. Once you respond, you're in. You'll get one email in your email box every day with our latest interview and our latest specials. And Andy, just really appreciate your presence here with us, the insight and the education you always bring. And thanks for joining us once again on Liberty and Finance.
Stay well.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.